Debt is a word that many of us are scared of. There are various television shows, books, and magazines dedicated to teaching people about getting out of debt. While debt can be viewed as a negative measure, it can also act as a positive one if utilized properly. The main method of using debt to invest positively is employing leverage to exponentially multiply your returns. So what is leverage exactly? Leverage is using borrowed money to increase your own return on investment. Leverage can let you achieve returns that you thought were not even possible, but at an even greater risk of losing your capital. Don't forget to watch today's video to the very end for different ways to make money with debt. But before we begin, we request you to subscribe to the channel and press the bell icon to never miss another upload of this channel. Having said that, let's jump right into the different ways to make money with a debt. So let's get started. 1. Margin investing. Investing on margin lets you purchase a higher dollar amount of stock than you actually possess money for. For example, if you possessed $50,000 in your traditional brokerage account, you can always leverage your investment and open a margin account. A margin account lets you put up a max of 50% of the value of a stock. You would possess $50,000 in cash, and an additional $50,000 would then be loaned to you from your broker. Your $50,000 investment adorns you with $100,000 worth of buying power. You can always use this money to buy $100,000 worth of stock. If the stock price then appreciates, you could pay back the loan and even pocket the profit. The negative of it is that if the equity within your account falls under a certain value, your brokerage firm can send out a margin call. If you are unable to meet your margin call because you don't possess enough funds, your broker can liquidate your entire position in stock, leaving you with just losses. 2. Leveraged ETFs. Leveraged exchange-traded funds let investors and traders amplify their returns by running long or short on a particular index. Fund companies, such as those of ProShares, offer leveraged ETFs that allow investors to multiply returns and losses between 200 and 300%. These funds allow you to invest in specific indexes, bonds, commodities, or sectors. Leveraged ETFs are sweet because of their exceptional profit potential. During market booms, you can easily achieve returns with leveraged ETFs that other investors only can dream about. The issue is that the same way that leveraged ETFs seem to work for you is exactly how they can work against you. Unless you are amazing at trading in and out of these funds, leveraged ETFs can actually magnify losses by wiping out your entire investment in merely a few days. Leveraged ETFs are often utilized by traders seeking to make short-term investments. Imagine that a trader is seeking the price of oil to increase over the course of a few days or weeks. A tiny position in a leveraged ETF can quite massively increase the trader's return if that prediction turns out to be correct. If a trader thinks oil's short-term price will decline, then owning shares in an inverse leveraged ETF can bring about a hedge against potential losses. But if a trader wrongly predicts such an outcome, then the leveraged nature of the ETF unfortunately amplifies the trader's losses. 3. Hedge funds. Hedge funds are one of the most prominent users of leverage. They are popular for generating abnormal returns by employing laws of leverage. Many hedge funds even seem to muster up to 10 times their total assets. Billionaire hedge fund managers, such as those of John Paulson, have employed leverage to turn accredited investors into straight-up multimillionaires. However, if the fund manager's investment thesis turns out to be wrong, this can drive a hedge fund right out of business and lose the capital of all its investors. Hedge funds, such as long-term capital management, which seem to need a bailout, get levered up as about 30 times their assets. Hedge funds are really viewed as aggressive and risky, particularly in comparison to mutual funds. This comes down to the method of investment. While every hedge fund seems to have its own specified investment strategy, the idea of hedge fund, given by the agency of the fund manager or general partner, to employ certain trading tactics, such as shorting stocks if they are expecting a drop in the market, or hedging themselves by going long if they are able to expect a market rise. As you can see, quite a lot depends on the ability of the fund manager to correctly guess future shifts in the market and react accordingly. Since hedge funds stand to be private investment vehicles, they can therefore bring about more or less whatever they like, so long as they are clear regarding their strategy to investors. While this degree of latitude can prove to be highly risky, it also quite attractively affords hedge funds a huge degree of flexibility. Hedge fund strategies may focus on macro investments in stocks, bonds, and currencies in the hopes of profiting from shifts in macroeconomic variables, example, global interest rates, economic policies, etc. Equity. Investing in stocks globally or nationally whilst hedging against downturns in equity markets by shorting overvalued stocks or stock indices. Relative value. Taking advantage of price or spread inefficiencies. Activism. Manager manipulating fund volatility by manipulating the board of directors, appointing new management, or pushing for the sale of a company. In addition to those, it is also possible for a hedge fund to employ a fund of funds strategic approach by mixing up other hedge funds or pooled investment vehicles. The target here is to better control the volatility, risk, and returns of the umbrella fund by strategically utilizing the underlying strategies and funds. 4. Short selling. Have you ever witnessed a financial program on television and accordingly thought that it's time for you to short the market? Short selling is a rather famous way of betting against a particular security by borrowing shares from a specific investor and selling them in hopes that the shares decline. Short sellers have brought in a fortune by properly timing declines in stock values. The downside to short selling is that losses may be unlimited, which means that short sellers can lose much more than just the initial investment. Why short? There are two main motivations to short. 1. To speculate. The leading reason to short is to profit from an overpriced stock or market. Probably the most popular example of this was when George Soros broke the Bank of England in 1992. He risked a massive $10 billion on the British pound falling, and fall it did. The following night, Soros made $1 billion from that very trade. His profit eventually touched almost $2 billion. 2. To hedge. It seems very few sophisticated money managers short as an active investing strategy, unlike Soros. The majority of investors seem to go the shorts to hedge route. This means they protect other long positions by offsetting such short positions. Restrictions. There are many restrictions on the size, price, and types of stocks that you can sell short. For instance, you can't short sell penny stocks, and most short sales require to be done in round lots. Short selling also requires that you put up a margin. As with a margin buy long transaction, the percentage requires changes depending on the eligibility of individual securities. 5. Forex Trading. Forex trading lets investors control large blocks of currencies with merely a small amount of money. Currency investors may lever up their accounts 100 to 1. The pros of currency trading are that you just use a small amount of money and turn it into a significant sum rather quickly. George Soros is famous as the man who broke the Bank of England, netting $1 billion by betting against the pound. Conversely, currency trading has the ultimate potential to clean out a trader's account in just a matter of seconds. The Forex market is currently highly accessible thanks in part to its low entry barriers and the high leverage that's available. This makes it famous amongst novice traders investing small deposits for modest returns, as well as the more experienced traders. Trading Forex successfully is not easy and does not happen overnight. However, for those who want to put in the time and effort and are willing to take the necessary calculated risks, it is possible to get rich trading Forex. With that, we end today's video. If you enjoyed the video, don't forget to like, share, and subscribe. Also, don't forget to join in the next time for more of such interesting content.